Awesome. So thank you everyone for signing on. We're incredibly excited to kick off our speaker event today. My name is Larry Gia. I'm a junior studying applied math and philosophy at Harvard College and one of the co-presidents of the Harvard College Economics Labs, an undergraduate-led economic research and policy think tank on campus. And before we get started, we just wanted to say a few quick words on the Harvard College Economics Labs.
Great. My name is Jonathan. I'm a current junior studying economics at Harvard College and the other co-president of the Harvard College Economic Labs. Just to maybe give a brief organization summary, we conduct pro bono economic policy research and have worked with organizations like the UN Development Program, the U.S. Department of Transportation, and public schools in the Boston area. If any undergraduates on the call are interested in learning more, please visit our website or email at LarryJohnMe. With that being said, we are incredibly excited to welcome our esteemed guests who have taken the time to join us today. To introduce our speakers, I'd first like to introduce Howard. Howard Marks is the co-chairman of Oaktree Capital Management, the largest investor in distressed securities worldwide, which he co-founded in 1995. Earlier on in his investing career, Howard led the groups at the TCW Group that were responsible for investments in distressed debt, high-yield bonds, and convertible securities, and served as chief investment officer for domestic fixed income at TCW. Howard is also a prolific writer, having published several books and admired in the investment community for his memos, which detail his investment philosophy and insight into the economy. According to Warren Buffett, and I quote, "When I see memos from Howard Marks in my mail, they're the first thing I open and read. I always learn something." It is an honor to have one of the greatest investing minds speak with us today.
Next, I'd like to introduce Professor Lawrence Summers. Professor Summers is the Charles W. Eliot University Professor and President Emeritus of Harvard University. During the past 2 decades, he has served in a series of senior policy positions, including as Chief Economist of the World Bank, Director of the National Economic Council for the Obama administration, and Secretary of the Treasury for the Clinton administration. He received his bachelor's degree from MIT and his PhD from Harvard. In 1983, he became one of the youngest individuals in recent history to be named a tenured member of the Harvard faculty and was awarded the John Bates Clark Medal. We are extremely grateful to have one of our generation's most prolific economists and policymakers in conversation with us today. So just a few logistics. Jonathan and I will be starting Q&A at 12:45. We prepared a few questions from those that you've submitted on the registration form, but please put any remaining questions you have in the Q&A chat below, which we will monitor throughout the conversation. And with that, I'll hand it off to Professor Summers and Howard.
Thank you. Thank you very much, Larry and Jonathan, and thank you to the Harvard Economics Labs for the opportunities you provide students. And as a policymaker, former policymaker, I can tell you that the products of the kind of research that you guys do can be something that's very, very useful. I feel privileged to have a chance to have this conversation with Howard Marks, someone who I have known for many, many years. And I do have frequent occasion to read his memos, and I frequently agree. But when I don't agree, I am always stimulated and educated by our disagreement. So, Howard, thank you for joining Harvard for this event.
Well, thank you, Larry. And I'll just say that Jonathan used you as bait. He said, "Would you like to talk to our group and be interviewed by somebody like Larry Summers?" I said, "If you can get Larry, I'm in." And I'm very glad to be here.
Well, I'm glad to have had the of the many roles that I have had in my life. I am now glad to add the role of bait for Howard Marks to my list of roles. Maybe, Howard, a place to start before we start talking about the details of the current situation would be this. You assess the world from the point of view of an investor rather than from the point of view of either a policymaker trying to make policy or an economist trying to make forecasts. And you've written powerfully and skeptically about forecasting as an activity. But of course, when you decide to buy one thing and not to buy another thing, or to go short something, in a sense, you are making a forecast of what's going to happen. So perhaps you might say something from your experience about the perspective investors take in looking at the economic and financial world versus the kind of perspective that economists or policymakers take, and probably what students learn in our classes at Harvard is more like the economist policymaker perspective and less like the investor perspective. So I think it'll be particularly valuable for them to hear how you contrast them.
I welcome the opportunity to do so. When I say I'm not that interested in forecasts, basically what I'm talking about is macro forecasts, economies, currencies, commodities, interest rates, and markets. Anytime we buy something or unbuy it, we're making a judgment about the future, but we tend to do it on the basis of judgments about the micro, companies, industries, and securities. And we're usually pretty agnostic with regard to the macro. And then, Larry, as you were formulating the question, I was formulating the answer. And I guess what I would say to this audience is that, December 1st, let's say, the Bills played the Pats. And a lot of people predicted that the Bills would win. They were right, but that was not a profitable prediction because the odds, the point spread, took the probabilities into account, rendering both sides of the bet equally attractive. So when we look at the future from the point of view of an investor, it's not a question of whether you can predict the future, but whether you can formulate a profitable prediction. If you predict something and everybody else predicts it and you're right, that prediction doesn't make you any money. And when I say we're agnostic with regard to forecasting, I haven't met many people in my 50 plus years in the business who could consistently produce profitable, which usually means non-consensus forecasts. So that's the point of view that I come from.
But now, that's a statement, I guess, about macro views rather than micro views.
Right.
In the sense that you have, by legend, fairly consistently outperformed markets. So that must be because you have made, your view would be you have made judgments about which, for example, debt securities are more likely to be repaid than the market thinks, and which are less likely to be repaid than the market thinks. But you believe that you are not able to forecast when bankruptcy rates are going to go up better than the market does.
Well, bankruptcy rates are somewhere in between the micro and the macro. That's a good example of something that's in between. Basically what I'm saying is, with regard to the micro, I think we can get, we and others can get an edge by knowing more than others. With regard to the millions of factors that produce the macro, I don't think we can get an edge in knowing more and processing the information better. Bankruptcy is, as I say, somewhere in between. And I would say that in general we have been able to have a superior view of that. Let me just mention in this context that my last book was called Mastering the Market Cycle, and when I was working on that with my son Andrew, who's a venture capitalist and my sounding board, I said, I think actually when I look at it, my macro calls about the market have been right. And he said to me, yeah, Dad, that's because you did it 5 times in 50 years. 5 times or 6 or 4 or 7 in my career, the market was so extreme and the logic was compelling and the probability of success was high. But if I had tried to do it 50 times or 500 times or 5,000 times, I would not have a batting average above 50%. So yeah, it's exception that proves the rule. It's possible at the extremes to make a profitable macro call. And if you're right about the fact, and my macro calls are usually predicated on an observation that the market is too optimistic or too pessimistic. And if you observe that the market is too optimistic, which usually means that people are lending money based on poor credit decisions, then I think you can predict that bankruptcies will rise. But those are rare occasions.
So let's move to the current moment. Either following the consensus or following your own instincts, where your own instincts might be out of consensus. How do you expect the economy to evolve over the next year or two? And then how do you expect that to be manifest in markets?
Well, it seems to me, Larry, that a lot of people today are saying, why don't we go back to normal, like the period from 09 to 19? And, one of my strongest beliefs is that period was not a normal period. That was an unusual period in which the global financial crisis necessitated a high level of stimulus, and the low level of inflation permitted it. And so the Fed reduced the Fed funds rate to zero at the end of 08 to fight the global financial crisis and left it there for 7 years. And that really created a halcyon period in which we had the longest economic recovery in history, the longest bull market in history, a very, very low level of defaults and bankruptcies, a good period of corporate performance. It was easy and cheap for corporations to raise all the money they wanted. It was just an ideal period. And in short, I don't think that the period ahead is going to be such a period. Clearly, the Fed can't be as stimulative because of the current level of inflation, and they probably have some conviction now that excess stimulation for too long is going to produce inflation. Most people conclude that there'll be a recession within the next year or two, and I find it easy to believe that because the record of producing soft landings, where the Fed cools off in the economy and inflation by raising interest rates, but not so much that it produces a recession. The record is poor in that regard. So, less stimulative Fed, the probability of a recession, credit not so easily available, defaults and bankruptcies. I think it's a different period. In addition, I believe something that I think you believe, which is that the growth of the U.S. And maybe not just the U.S. is decelerating. Again, people say, well, why don't we just go back to normal like the second half of the 20th century? I think that was the greatest period in history. And there were a large number of reasons why economic growth was unusually good in that period, and because those are reversed, and for other reasons, it's not going to be as strong in the period ahead. So I think that I don't know if we're going to have stagflation or just stagnancy, but I think that and by the way, this longest economic recovery in history, which we had in the last decade, was also the slowest. So that I think supports the argument that we have slow growth ahead and a less ideal environment for corporate managements and for asset ownership.
So you and I are in agreement on a lot of stuff. I've put it by saying that Samuel Johnson said that second marriage was the triumph of hope over experience. Right. And I feel the same way about the idea of soft landings. Mm-hmm. Certainly the yield curve suggesting interest rates will, over some interval, decline quite significantly, which is something that usually happens when the Fed becomes alarmed about recession, goes in the same direction. And contrary to what many people expected, and despite all kinds of geopolitical instability, oil prices have fallen a fair amount. And many people think that that has to do with what's happened to demand. Certainly other commodities have come down. It's been puzzling to me that the stock market is as strong as it is. If you think that we are headed into a significant recession, usually profits decline by 8% for every increase of 1% in unemployment or some such. There's likely to be adverse effects on the availability of credit, which is a bad thing for companies, to the extent that there's a dawning awareness that slow growth lies ahead. That should cause the price earnings ratios on securities to decline. And yet, if you look at the level of markets right now, they're below the kind of peak euphoric levels that they reached, but really not by that, by that much. How do you understand that, and what's your reaction? I think you said in your latest letter you were more upbeat on the idea that people should be starting to buy stocks than I actually expected you would be, given the way I think you and I both understand a lot that's going on.
I would say I'd have to go back, and as I say in trials, I'd have to be refreshed. But I think my position is I'm less negative as opposed to being more positive.
Fair enough.
Now, as for the delay in the reaction, what I would point out is that what you learn in school is the way things are supposed to work, and most of economics is about the way things are supposed to work. But Yogi Berra said that in theory there's no difference between theory and practice, but in practice there is. And when you get out into the real world, you see that investors fluctuate, and for a long time, for example, they'll emphasize the positives, ignore the negatives, and if things are ambivalent, interpret them positively. Then all of a sudden they'll flip and do the opposite. But for it to happen all of a sudden, there usually has to be a catalyst, and there hasn't been a catalyst. So I think that people are holding on to old positivity, and we know that if people hold a certain view, when new information that comes in that is in contrast with that view, the brain has mechanisms for ignoring it until it becomes so great that it can't be ignored, and that's when people flip. There's an old saying in the markets that things take longer to happen than you thought they would, but then they happen faster than you thought they could. And so I think that in the absence of a catalyst, and there hasn't been one, there hasn't been much of a scandal other than maybe FTX, or some people tried to gin it up with regard to what happened to Blackstone this week. In the absence of that, people can still hold their views, which, as you say, might be more positive than they should be. And the other thing about saying that I think it's time to start buying, I hope I was talking about credit and not stocks. Credit has cheapened significantly. The only other thing I want to add, Larry, before I let you speak again, is that you talked about oil prices being down, and I think that for the people in the audience who are taking or have taken Econ 102, which is micro, it's a great illustration, because we always say that the solution for high prices is high prices. High prices encourage supply and discourage demand and result in lower prices. And I think this may be a great example of that.
I agree with you. I agree with you about oil. I always quote precisely the proposition you quoted about things take longer to happen than you thought they could.
Yeah.
than you thought they would, and then they happened faster than you thought they could. I attributed it to my late teacher, Rudy Dornbush, but I think it may well have been said by someone before that. And by the way, I think it also applies to new technologies.
Right.
Take autonomous driving. Autonomous vehicles are arriving much more slowly than anybody expected 5 or 7 years ago, when it was generally felt that they'd be pervasive right now. My guess is there'll be some 3-year period sometime in the next 20 years,
right,
when they will go from being remote to being commonplace. In 1999, I would have expected that by 2007, I would be reading the New York Times on an electronic reader, but it didn't happen. But there was a period of several years, some years ago, when exactly that kind of move took place. Do you believe that you made reference to the era of low interest rates in the decade after the great financial crisis? There's a controversy among people who watch these things. I think almost everybody agrees that the big decline in interest rates that took place is a kind of seismic event. And I think almost everybody thinks that, to take an example, the fact that a 10-year index bond traded with a 3.5% yield at the end of the 1990s, but traded with a negative yield at the end of the decade of the noughts, is a huge thing, pushing asset prices up, pushing returns down. So I think everybody agrees that this is a very big thing. There's a controversy, I would judge, between two perspectives on it. I've been a prominent advocate for one, and then there's a different perspective, and I'd be curious to get your view. One view, which has tended to be my view, is what I would call what I called secular stagnation. The idea that there were fundamental things that had changed in the economy, where a lot of people wanted to save because more of the income was profits going to rich people and who were worried about their long life expectancies after they retired. And there was less demand for investment because the price of information technology came way down, because the population was shrinking, was not growing at the rate that it had earlier, because people started wanting urban apartments rather than big suburban houses. And so there was a kind of fundamental change between patience and productivity that led to lower interest rates and led to a set of other things that the central bank, wanting to avoid inflation and maintain the economy at capacity, kind of had to set lower interest rates. And that's just sort of the way it was. That's one view. A different view that would be taken by many people in the financial community would say, no, we just sort of had a misguided era of central banking, where we systematically just provided excessively easy money, and we pumped up these bubbles, we created all these zombies, and that it was an era of misguided monetary policy for which we may now pay a price in lower returns and worse economic performance going over the next decade. How would you think of yourself as positioned between those two views?
I think a kind of a combination, and I have a memo coming out Tuesday on this subject. By the way, the title is a sea change, And I think it is a sea change. I think the first one was the decline. You know, I had a loan outstanding from a Chicago bank in the 70s at 3/4 over prime. And I saved and framed the slip from 1980 that said the rate on your loan is now 22 1/4. And 40 years later, I was able to borrow at 2 1/4. I think that obviously a lot of this was just coming off from the exaggerated rates that Volcker used to fight the inflation of the 70s. Then rates tended to kind of normalize over the next 20 years or so. But I, you know, my own belief is that the rates of the teens of the past decade were not what I would call naturally occurring, but they were administered at very low levels. And, you know, I guess there's a bias toward low rates because everybody likes them. You know, the borrowers like them, the government likes them because it makes it cheaper to issue debt and so forth. And the markets push back on any attempt to raise rates, you know, temper tantrums and so forth. So I just think that the rates were pushed down and kept down at unnatural rates, and I think we're going to go back to something more normal, whatever that means. And in this memo that's coming out, I said, by the way, I'm very explicit that we don't bet on any forecasts, including mine. But I think that the Fed funds rate over the next X years, several years, I say, which I think of as 5, 6, 7 years, is going to average in the 2 to 4 range, not in the 0 to 2 range. That's my own bias. You know, when I started managing money in 78, the Fed funds rate was 9, but of course that was the inflationary period. But in 05, 06, 07, I was worried about the markets, and I put all my money into treasuries, 1, 2, 3, 4, 5, 6 year treasuries, and I was making about 6% on riskless treasuries. So, you know, we spent a long period when rates were 0 and treasuries were 1 to 2. Now they're 4, and I think that 4 is kind of a normal rate and sustainable.
You and I have longer memories. I'll just tell the students the story of how, as Lawrence mentioned in introducing me, in 1982, I was recruited to be a professor at Harvard. And I, at the time, was at MIT. And so Harvard and MIT were competing for my services. And Harvard had a lot going for it by virtue of being Harvard. But a not unimportant consideration to me at the time was that Harvard was prepared to give me a 9% mortgage. And MIT was not prepared to give me a 9% home mortgage. And that was really very important to me because in the market, I could have only gotten a 14% mortgage to buy what turned out to be my first house. So it has changed. Your comments about the Treasury and the Fed funds are sort of interesting because they illustrate something you said before. Depending on just what the horizon is, if you look at the rates that are in the market on treasuries of different maturity, it's kind of saying that you're right. It's sort of saying that rates will be somewhere in the 3s for most of the next 10 years, and it's fluctuated around. So the market has kind of come to your view. Here's a question I used to think a lot about when I was president of Harvard, and now I think about it when I think about finances for my kids, or still think about the university. There's a kind of rule that has sort of grown up over many years, that if you have an institutional type portfolio and you don't pay taxes and you want to spend it without its value going down. So you want its size to keep up with inflation. There's a rough rule that's around that you can spend 5% of it each year. And that's the rule that Harvard has used for many years. It has occurred to me that if that was the right rule when index bonds were at 3.5%, it might not be the right rule when index bonds are closer to zero. And if that was the right rule through this golden age for assets that you're describing, if an institution came to you, or an individual planning their retirement came to you, and they were going to have a pool of money that was going to be professionally, competently invested, and they wanted to maintain principal and only spend the real income from it, what would you tell them today was the right figure to use in doing that calculation?
Yeah, well, great question. I think you have to figure out what you can make and then subtract the inflation from it. And what remains is what you can spend. I'll just illustrate, Larry, 5 or so years ago, I took over as chairman of the investment committee at the Metropolitan Museum of Art in New York. And the first document I got from the staff said, talked about making 7.5% nominal. And so I said, you better get rid of that. I think you can make 5.5% nominal safely today. And then, of course, at that point, everybody was still thinking about inflation of just around 2. So that means you could spend 3.5. Of course, that spending number should not change very often. And as you indicate, in the past several decades, it hasn't changed at all, really. Part of that is that I think there's a legal obligation in foundations to spend 5%. So people anchor to that. But so I said, you better go to 5.5, because we were in a low return world. Most asset classes had the lowest prospective returns in history because of the low interest rate climate. Being democratic, at the next meeting, we put it to a vote, and I had everybody write down what they thought we could make safely and dependably, and the consensus was 6. So we went to 6. But still, you're right. I mean, and by the way, I gave a speech from 2012 to 2020 entitled "Investing in a Low Return World." And so if you're in a low return world, you can't spend what you used to spend. But I think right now, it may be over. It's over in terms of nominal returns. We have to see whether it's over in terms of real returns. But a year ago, high yield bonds, which is what I cut my teeth on, yielded 4 to 5. Not very useful if you needed 7. Today they yield 8 to 9. And if they get inflation under control, if they can get inflation down to 4, let's say, then you can spend 5.
If you were on that board today, and they asked you 2 questions for the next medium term period, what nominal return do you think you can earn, and what inflation rate do you think you should build in? What would your answer be if you were on that board today?
Well, today I think you can make 7 nominal, and but I would tend to build in 3 inflation at least, and so I would say that I would go to 4 and see if that works. See how inflation is running in a few years. But obviously, to believe that you're going to make 5 real today is optimistic, I think.
Let me ask you a very different question. You have been very involved in the organization No Labels.
Yes.
and have been an important supporter of it. I think because well, I'm gonna ask you why you have been involved in that, and what's your kind of reaction to the state of American politics at this moment?
Well, it doesn't take excuse me, it doesn't take a Harvard IQ to know that our politics today is riven by partisanship, and it's full contact politics. And there's no greater epithet, I think, in Washington than to say he cooperated with the other side. He voted with the other side. He compromised. And if as long as we have two parties, and as long as we have differences, I think we need cooperation and compromise. And compromise can't consist of the party in power saying, let's compromise, we'll do it my way. And so No Labels supports members of the House and the Senate who vow to work with the other side and solve problems and produce solutions. We have problems that have to be solved. Take, for example, Social Security. There are projections for when Social Security is going to go bankrupt. They keep getting closer and closer and closer, and nobody does a damn thing about it, because everything you could do about it requires that some votes be lost, because the other side would make hay of your vote. You have to either increase the age for retirement, increase the amount that's taxed, increase the tax level, cut benefits, means test them, put some limitation on how long you get them for. All those things are going to make people unhappy. And we have this enormous segment of our population, which is the retirees, or soon to be retired. No, I guess retirees. They're all old like me, and they're going to be unhappy. You're going to lose votes. So, but if you could put together a bipartisan effort to do it, if you could appoint a nonpartisan commission like we've seen in the past, that's how you solve these problems. In a partisan world where everybody's just looking for a gotcha moment, you'll never solve any problems. And I don't believe in a hyperactive government, but I believe that there are some problems that the government has to solve. So, in short, the members of the House and Senate that No Label supports are people who are willing to lose their job to do the right thing. And I think that most incumbent politicians, goal number one is to get reelected. Goal number two is to get reelected. Goal number three is to get reelected. Nothing else matters. Maybe some people need the job. I don't think it's the greatest job in the world. It's certainly not the highest paying job in the world. If you want to be a public service, you should be it. But that public service should consist of being willing to lose your job when you vote for the right thing. So I think that No Labels is a great organization, and I feel better about my involvement in politics than I ever did before 2015, which is when I joined.
Do you think people should be comfortable compromising with election deniers?
No, but not at all.
You think you shouldn't even try to compromise with them?
No, but you should. No, not at all. But in all matters, you should look for areas where you agree with the other side, or where their views have some overlap, some intersect with yours, and you should try to fashion compromises in that range. You should never vote for something that's against your principles.
I basically have the same kind of convictions that you do, Howard, but I have worried in the last year or two that the principal area of bipartisan consensus that I can see in the United States is around how hostile and truculent we should be towards China. And I worry that being extremely hostile and truculent towards China is compromising a lot of values that are very important, and that we've got more of a bipartisan bidding war than a bipartisan consensus. And that's pretty problematic. I'd be interested in your view there.
No, I agree 100%, Larry. I was talking to a group up in Canada on Tuesday, And I said, I think the one thing that both political parties agree on is China bashing. And, you know, nobody said much for a long time. And then Trump was extremely outspoken with China bashing. And then now the Democrats can't be outdone. So they have to do it too. But clearly, if you get out of your room and you look at the real world, you have to be pragmatic in the real world, and you have to find solutions that are going to work for everybody, or else you're going to have conflicts. So I do not think it is at all productive to do China baiting. I think you try to defuse the tensions, not exacerbate them.
I'd agree with that. We're going to close this. We're going to close this out before we turn to the students for questions with a lightning round. I'm going to give you a topic, and you get to say long or short with one sentence, no more of explanation, and you get 2 passes over the course of the lightning round. The United States.
Long.
Elite higher education.
Long. I mean, it's going to run into tough times and challenges, but we have to have it.
The fintech.
Long. I think that the democratization of finance is very important, and like everything else, a lot of finance is going to be done over the internet.
Crypto.
Don't tell my son, but short.
Blockchain.
Long.
The green technology.
Long within limits. You can't make your decisions just on the basis of greenness. You have to look into other things, like Germany moved to a green energy posture, and now they say, just a minute, we're dependent on Russia. So they emphasize greenness and overlooked security.
Industrial and manufacturing activity.
In the U.S.
In the U.S.
Neutral. I don't think it's going to get that much worse, but and there'll be a little reshoring, but I don't think it's going to change that much.
Careers for 22-year-olds in financial services.
I think financial services are great for some people, not for everybody. Look, Larry and I talked about some of our views today. We agreed on some, disagreed on some we agree on, and everybody else disagrees with us. So you're not going to bat 1,000 if you go into an area like economics or investing, but it is intellectually stimulating and challenging. And you can't have intellectually stimulating in an area where everything is cut and dried and there are algorithms that always produce the right answer. Then that's when the intellectual challenge goes out of them. So I think they're great for people who don't have to be right all the time.
The West Coast versus the East Coast.
Californians make their lives comfortable. New Yorkers make their lives interesting.
All right.
Larry, my mother used to say, what do you like better, the summer or the country? Some choices are tough.
All right. I'm going to toss it back to you guys, Lawrence and Jonathan, to ask either of us whatever you want.
Awesome. Thank you so much. That was such an interesting conversation. I guess I can start off with one question, which is, I think many would agree that the Fed was a little late taking away the proverbial punch bowl from the party. I was wondering why you think that was. Is there something structurally deficient at the Fed or with its tools, or was it a simple miscalculation?
Gee, I don't know. Larry would know much more than I do. By the way, if you want to talk about slow taking away the punch bowl, look at the first half of 2021. We were having a housing boom, and the Fed was still buying mortgage securities to make it easier to finance housing purchases. And that was a much more, you didn't have to have a crystal ball to choose between transitory and long-term in order to see that was a mistake. I don't know why these things happen. You, Larry?
I think they were way behind removing the punch. I think it was a combination of organizations want to make new mistakes, not old mistakes.
Mhm.
And there was a feeling that we had been insufficiently stimulative for 10 years.
Yeah.
And that's why the recovery had been so slow. There was a sense of wanting to side with the new administration and against the pandemic. And so that meant being generous and stimulative. And there was an analytical error of failing to recognize that if you studied a 40-year period when inflation didn't fluctuate, you were going to conclude that nothing could change the rate of inflation, even though a richer reading of history would suggest very much otherwise.
Interesting.
Great. Our next question is regards to the increased global government debt load in a post-COVID world. The UN estimated that 44% of low-income and least developed countries are at high risk of external debt distress or already in distress. Should this be a concern? Are there any similarities that can be drawn to the periods of default in the 80s with the Volcker shock or Asian financial crisis in the 90s? And this is for both of you.
Larry, that's your territory.
I think there's people are right to be very anxious about it, but I think it is today much more a moral issue and much less a systemic financial issue than was the case earlier. During the Latin American debt crisis of the 1980s, the major New York banks had an amount of money equal to 3 or 4 times their capital lent to Latin America. There's nothing remotely like that in the exposures to the problematic countries today, not 1/10 of their capital, let alone 3 times their capital. And the locus of concern today is much more the poorest countries than it is the Brazils or the Indias. So I think this is hugely important as a humanitarian issue. I think it is hugely consequential as a geopolitical issue, since the kind of influence we have in Pakistan versus the kind of influence the Chinese have is a very important issue. But I think it's not a systemic financial issue to the extent that it was either in the 80s or during the Asian financial crisis.
And the other thing I think is worth noting is that we seem to have a pretty good mechanism for solving these problems, because we had a lot of over indebtedness in the 80s, but it got worked out. You didn't have many rejections of debt as a consequence.
Howard, I would is one of the first places I would disagree. I would disagree with you there. I think if you made a closer study of how Nigeria's excessive indebtedness was going to be dealt with, or the debt problems currently facing Sri Lanka, I think you would feel that the kind of relatively efficient mechanisms that you're accustomed to with respect to the distressed debts that you buy are very much absent with respect to people who borrowed from the US Exim Bank and the Chinese Development Bank and the World Bank for infrastructure. I think I was very involved when I was Treasury Secretary in a debt relief initiative for highly indebted poor countries in 2000. And I think the system right now at the level of global sovereigns is actually in a pretty bad place. So I would not share your enthusiasm about the mechanism.
Well, it's not for nothing that our distressed debt funds, which, as Jonathan said, I think are the largest in the world, have never bought a sovereign credit.
Right.
Amazing. So I guess the next question would be, we've seen a lot of blow-ups in the last couple of decades, from LTCM all the way up to very recently Archegos. But one that's captured the headlines in kind of recent weeks has been the FTX. And I'm wondering if you think if there's anything new about the economics of the FTX collapse. Does it follow a simple story of leverage and unregulated maturity transformation, or has technological innovation fundamentally changed the way we think about macro Peru risk?
No, I think it's just the same. You know, Mark Twain is supposed to have said, "History does not repeat, but it does rhyme." And there are certain things that happen every cycle, and one of them is that when the band is playing and everything gets cooking and there's optimism every place, then the fear of losing money dries up. The fear of missing out takes over. The level of due diligence declines. Credulousness appears. Skepticism dries up, and crazy ass schemes can raise money. You can't do it in a bearish period, or a period of pessimism, or a period of worry, or a period in which people are losing money. But when people are making money, other people want to jump in and get some. And there's a book by Kindleberger about panics and crashes, and he says there is nothing so injurious to your mental well-being as to watch a friend get rich. And when people are making a lot of money, really bad things happen. Fear of losing money is what keeps the market safe and sane. And when it evaporates, it's very dangerous. And so the FTX is not a tech issue. It's a human gullibility issue.
I would say two things that are in the same general direction as Howard's. One is nobody who graduated summa cum laude from a college has ever fabricated their resume. So when things get bad is when people steal their customers' money. When they haven't lost their own money, they have no need to steal their customers' money. So fraud accompanies trouble. And in general, I think if the world had 5% fewer PhD economists and 5% more forensic accountants, it would be a better place. And the second thing is that there's something very fundamental about credit that we don't tend to teach in economics classes that is really very, very important. And that is that it's very hard to default in a period of rising availability of credit. Suppose I can't pay because I, lost my job or whatever. In a period of rising availability of credit, I'll get a larger credit card and I'll borrow on it to pay my debt back. Or I'll refinance my house, which has gone up in value, or I'll refinance my car loan payments after 2 years. And with rising credit availability, even the people who are meant to go bankrupt, because they're not really able to pay anything, don't. And so when the growth in credit stops, that's when you start to see a huge wave of defaults, because all the defaults that should have happened earlier start to happen. It's actually, in economics courses, everybody on this call has studied the accelerator as regards to physical investment. That, when your economy is growing, you need to grow more capital. And then when the economy stops growing, investment falls off. But I think the credit accelerator is actually probably an equally important phenomenon. And I think both of those things are important in understanding FTX. A very important life lesson for everyone on this call is, if it seems too good to be true, there is a very substantial chance that it is too good to be true. And ethical problems, whether it's Enron or whether it's Nazi Germany, or whether it's FTX, there are always going to be people who do bad things, terrible things. A ton about whether things stay ethical has to do with when people suspect that the emperor has no clothes, whether they're willing to put the question. And healthy organizations and healthy societies have the feature that the uneasy and the questioning are able to speak up. And things go badly wrong when the uneasy stop having the ability to speak up, as they did at FTX, as they did at Enron, as they did in Germany in the 1930s, and as they do in certain parts of the world today.
You know, I think one of the biggest lessons that I learned over the first half of my career is the importance of the swing in the availability of credit. And I devoted a chapter to it in my book on cycles. But easy money, I think bad things happen. Hard money, those bad things get tested and exposed.
Great. Well, I think we have time for one more question. To maybe conclude, and this is a question for both of you. In the next 10 years, what trends in the economy or in the macro are you excited / optimistic about, and what keeps you up at night?
I'm not much of a futurist. I tend to respond to events more than anticipate them. The only thing that keeps me up at night is if I think we'll have a shortage of investment opportunities. So we pray for the occurrence of some bankruptcies and defaults. It gives us more to do. And the other thing I'll mention is that that the fear of bankruptcy is to capitalism as fear of hell is to Catholicism. And when we have defaults and bankruptcies, we get a relatively good level of risk aversion, and people don't do crazy things. But in the absence of defaults and bankruptcies, they do.
I would say that what keeps me up at night is populism and the things that come out of populism, both domestically and globally. And what keeps me optimistic is the conviction that events are 75% bad, trends are 75% good. We tend to focus too much on events and too little on trends, and that there's a ton of technological, organizational, and moral progress that is always going on, and that the United States in particular has a remarkable capacity for self-denying prophecy. Jimmy Carter's malaise speech, the people who told Franklin Roosevelt he needed to become a dictator, the fact that Patrick Henry said that the spirit of the revolution had been lost in 1792, and that's what we need to address. That as long as we have that capacity for self-denying prophecy, I think the line that is attributed to Winston Churchill, although I don't think he actually ever said it, will turn out to be right. That the United States always, always, always does the right thing, but only after exhausting all the alternatives.
Well, I think that's all the time we have. It was a fascinating conversation to listen to, and on behalf of the entire economics team, the Economics Labs team, we are really, really appreciative of your time today. So thank you.
And I want to thank Larry for participating in this with me. He made it a great experience.
Thank you, Howard. This was great.
Thank you, everyone.
Thank you.
Bye-bye.
Bye-bye.